everybody, and welcome. Tom Daly here from the Academy of Financial Trading. We are about to begin your 5th lesson in your foundation trading program. This evening's lesson is going to be very, very exciting because we're going to be building upon lesson number 4, where we looked at Japanese candlesticks, where we said that those colourful little devices they are showing us who is winning a particular battle, which I guess will help us to understand who may be winning the war. So we want to build upon that this evening. As per usual, let's start out with our risk warning. It's important, guys, that we're all aware of the risks associated with leverage trading. What we aim to do is we aim to help you to mitigate, to lessen those risks in as far as is humanly possible. In order to recap upon where we left off, we looked at these areas. We said that Japanese candlesticks are incredibly important for measuring high, low, open and close areas. Crucial information. So this evening, we want to build upon that. We're going to talk about support and resistance. Guys, who on this webinar has looked at support and resistance previously? Who has traded using it? Has anyone looked at it? Has anyone any knowledge of it? Let's have a look and see. I can see Giuseppe and Simon. You have Johan. You have Christopher. Christopher, you're saying you have a basic understanding. Hans, you have. Miguel, you're saying you did. Only briefly, says SB. Okay. Who else have we got? A little, says Vidar. Looked at Lori but not traded. Okay, if you haven't, don't worry about it, because we're going to start at the very, very beginning. And even if you have experience in it, we're going to look at it maybe a little differently and show you the fuller picture. We're also going to look at breakouts, we're going to look at trends, we're going to look at channels, because these are all part of the same family. And that family basically revolves around lines or barriers in the market. Barriers in the market which, if breached, can result in interesting opportunities. So let's speak about these. Support and resistance are just like floors and ceilings in the marketplace. In the room that we're all in now, you would imagine that there is a floor and a ceiling. Otherwise, you're either levitating or you're watching the evening sky. We say that a floor or a ceiling, it would tend to act as a barrier. That idea of tending to resist something, that's crucial, because we can all imagine that if one threw a tennis ball up against your ceiling, it would bounce back down. You would say that that ceiling tended to act as a barrier. But if one loaded a cannon, a physical medieval cannon with gunpowder, and dropped that tennis ball into it and aimed it at the ceiling, one would imagine that the ceiling may not still hold the tennis ball. Just like if the price hits an area, it might bounce, but if it is powerful enough, it could break through. We say that the bottom end area is known as a supportive point, a floor in the market. We say that the top level area is a resistance point. So these are just the terminologies which we will be using throughout. We stress that they are zones and not lines. What we mean here is that other educators who may want to make trading look easy, they will tell you that they are perfectly drawn straight lines. They will be in the examples which they use, but not in the real world. So we're going to show you how they're not always perfect. There may be question marks over them. They are uneven surfaces. So we're going to show you how to interpret that. So we say that the floor in the market is called support. The question which some people might have already typed in, it tends to be along the lines of, why does this happen? You as a trader and we as human beings, we've got an insatiable appetite for that word why. We just prefer to say that we don't actually know why. We prefer to openly admit that we don't know what the future may hold. Anyone who says that they do is speaking nonsense. So we say that the price is bouncing in a particular region because for whatever reason, people are trading around that area. It's just that simple. So let's speak about, I guess maybe to really resolve your own curiosity, or I'll tell you what, why don't we ask the question? Why don't we put the question to the floor? Why do you think the price might bounce at a particular area? Imagine your own domestic housing market, and let's imagine that house prices fell from 400,000 down to 300,000. Why might they not go any further than 300,000? Relate everything back, guys, to something which you're comfortable with. Relate it back to a car. Relate it back to a house. Relate it back to a horse, if you will. Whatever it is that you are comfortable with and you might know a lot about. Why might a price not go below a particular level? You guys know the answer to this. All that we've got to do is show you what it is. Why would it not do that? And great stuff, guys. The participation, the engagement is fantastic, and that's what makes these webinars an enjoyable experience. Okay, so what have we got? Pamela, you're saying someone has to make a profit. David, you're saying the market levels out. Ramesh, you're saying the supply may be more. Rickard, you're saying no one wants to sell. Paul, you're saying not good value. Anchoring, says Dean. Cost of the house, says Gulnaz. Okay, it always has to do with supply and demand, and that could be related to the assumed fair value. Maybe people remember a time where it cost much more. Maybe a lot of people had borrowed money. Maybe they had paid much greater than 300,000 and were therefore unwilling to sell below that level. Maybe there are psychological issues of the pain which might be caused if they did indeed sell below that level. Maybe it's the intervention of some third party. If you were talking about a housing market, maybe it's landlords coming in to buy the properties because buy-to-rent yields are very favourable at that level. Or maybe it's the intervention of another type of third party like a national bank. Okay, like a national bank. So let's look at this, because there are a lot of very valid questions which are coming in. On this chart, you're looking at a Euro-Swiss franc chart. This was a fantastic period of trading. Anyone who can remember that 120 Swiss National Bank peg will know exactly what we mean here. Imagine this scenario. I'll explain this chart to you. Imagine that you are Switzerland. You're an economy which is driven by exporting services or products. Your largest trading partner is the European Union. Your currency is strengthening relative to the euro. If you see on the left-hand side of this chart, you can see that the euro is weakening, the Swiss franc is strengthening. Can we all see that? The Swiss franc is falling, so the euro is weakening, the Swiss franc is strengthening. Now, if you're Switzerland, that's very bad for business. Because all of those fine watches and all of those fine chocolates and all of those services which are provided by Switzerland, they become more costly very quickly. Therefore, you, as the Swiss National Bank, the SNB, you might come into the market and start buying at the 120 level. And if you buy enough of it, it will keep the market up. Let's explain why. If you were a seller, why would you sell at 119 when there is a willing buyer at 120? Does that make sense, guys? If there are enough willing buyers at 120, why would people sell at 119? They just wouldn't. It would be a very silly move on their part. Supply and demand as usual. So what the Swiss National Bank do is that they keep buying at 120. They tell the market that they're not going to let it go below that level. There has been examples of failures of this in the past. Back in the 90s with George Soros and the British Bank. More recently at the start of last year, or around about this time last year, this actual market action failed. Okay? But let's have a look at that in a few minutes. Okay? Let's imagine how the Swiss National Bank feels at this point in time. They are buying consistently at 120. Would they be winning or losing if the market moved down to 119? would they be winning or losing if the market moved down to 119? If you pay 120 for something and if it drops to 119, are you in a winning or a losing position? What do we think? Absolutely, you're in a losing position. You might be asking, well, why are we talking about this? We're talking about this because there is a clear floor in the market, a clear support area in the market. And what that tells you is if those people who bought at 120 get it wrong, they will all be losing at the same level of 119. And we know that when people lose, they panic, they flee, they run. And how you get out of a losing long position is by selling it. And if everybody sells at the same time, it will push the market further and further and further down. Does that make sense to everyone? These areas are important because they show you where people may lose. And when people lose, they become more predictable and we find opportunities as a result of that. This market ultimately took off to begin with and moved quite dramatically to the upside. It went from 120 up to about 125. Where that third party, that Swiss National Bank, is coming in, protecting their economy, buying at 120 and driving the price upwards. We're going to come back and show you what happens when these support levels fail in just a few moments. But before we go into that, we want to show you that it's not about how you or we feel about a market. It's not what a commentator says about a market. It is what people are actually doing in a market. Okay? It's about trading. It's about like people buying houses. It doesn't matter how much we shout about it. The price can only go up or down when people offering and accepting prices. We are focused upon when people get it wrong, because that's how a market maker operates. That's exactly how a market maker operates. They analyze when people get it wrong and they take advantage of those sorts of opportunities. So let's have a look at what happens when indeed it does go wrong. What I want to draw your attention to begin with is the price on the very top right hand side of the screen. That was the initial range which we have spoken about from just 2 slides ago, from that 120 up to that 122, 123, 124 franc level. Okay, that was the range we were dealing with for such an extended period of time. It was all the way through 2013, all the way through 2014, right to the start, pretty much to the day of this day last year, there or thereabouts. And on that day last year, what happened was the Swiss National Bank, they came out and they said that they were no longer going to support the Swiss franc at that 120 level. They were no longer going to be an active buyer in the market. And can we all see what happened? Can we all see the panic which existed when that floor disappeared? Can anybody type in and tell me exactly what happened? Can anybody tell me exactly what happened? What is that long candlestick telling us? Johan, you have it in one. We have extreme panic. We have everybody selling. We have a massive price drop. We have every single person taking the opposite side of the trade. Because if you think that you are trading very similarly to a Swiss National Bank, and if that Swiss National Bank is constantly telling the market that they are buying, you would have a lot of confidence that you are in the right direction of the trade. And when you're in that right direction of the trade, that supposed right direction of the trade, and then when that protective entity, that Swiss National Bank, comes out and says that it's no longer supporting that floor, you would absolutely run. You would run to the hills. And what happened was a trading range, a new trading range was brought in. The price dropped from 120 all the way down to that 86 level in the space of about 10 minutes. It was a generational event. It was the type of movement which only happens once in a generation. Aslam, you're asking why did they stop the practice of supporting the franc? A lot of people are saying simply because they couldn't afford to anymore. It was costing them too much money and they just decided to stand to one side and let market forces dictate what the level should actually be. But again, we're asking why. Okay, I actually don't know why, but it must have cost an absolute fortune to do so. And we can see that new trading range was then brought into effect between 1 franc and up to 105, 106, 107, 108, 109, there or thereabouts. But we need to look at these floors, we need to examine them, we need to understand them in a lot more detail. So let's have a look on this historical euro-dollar support chart. Okay, the first question is, how do we draw these lines? Do we all remember that childhood exercise of connecting the dots? You connect up the dots on a particular item. And can we all agree at number 1, there is a low level in the market? There is a low level in the market where the market has bounced up from. Picture that tennis ball bouncing off the floor and moving on. So you say that's one bounce. And then we go and we connect up the second bounce of the tennis ball. And everybody see that? You're just connecting up the second bounce. And after you've got 2 bounces, you might say you've got a floor. And that's how we would have drawn that top line. And then we get some lower levels at 3. So you connect up all of these dots to form an approximate support area. You will notice that that is clearly not a straight and perfect line because that's not the way the markets work. This is telling you this is a rough area where the market is bouncing. It's an uneven floor. It's not perfect. So let's look at this further. Imagine this scenario. Let's say that a new trader, a trader who has completed a course elsewhere, and you might have bought into the hype of financial trading, let's say that they buy at that first green arrow. And let's imagine that you make 1,000 of your own currency, whether it's pounds or dollars or euro, whatever the case may be. Let's imagine you make $1,000 in this scenario. How do you think that trader feels? How do you think that trader feels? They've gone out, they've placed a trade, they've made $1,000. How do they feel? Absolutely, they feel elated. They feel like a king of the world. They feel pretty good. They're happy. They're fantastic. Okay? They're very pleased with themselves, Bob. Absolutely. They're encouraged, Mark, without a doubt. So the second time that market bounces, what do you think they'll do? They made money the last time it happened. Could we all agree that they would do it again? Could we all agree they would try it again? Absolutely, Laura. Why not? The last time they made money, they realised they're good at it, so they probably do it again. They make another 1,000. The third time, what do we think they'll do the third time it bounces? They're right again. Life is brilliant. They're happy. They are confident. So they do it again. The fourth time. And after the fourth time, or maybe even the third, or maybe even the second, or maybe the fifth, but on one of the later times, they're going to say to themselves, well, what if I had taken a bigger trade? What if, instead of making 1,000, I aim to make 10,000 or 100,000? Can we all see that there is a very high likelihood that they would increase the amount that they are speculating with because they're on a roll? Everything is working right. The market is massaging their ego. So on the fifth time, can we all agree on that fifth time on the right hand side, it would be a much larger position than number 1? Can we all agree with that? It would be much, much bigger than it was at the very first attempt. It would have to be, absolutely. Now we've got a clear floor in the market. And you as a trader who's learning the right methods, you can see that there is a floor in that market. There is a clear floor at that 135 level. And we would know that all of those who bought at that point number 5, they would be in seriously losing positions if the market dropped down to that 134.5 level. Can we all agree with that? If the market went down 2x, everybody who bought at 5 would be in seriously losing positions. Could we agree with that? Absolutely. So what would we like to do if the market did indeed move down 2x? What would we do if the market moved down to X? What would we like to do if the market went down to that level? Absolutely, we'd like to short sell. We'd like to speculate that the market will continue downwards because people will panic and they will push it lower and lower and lower as they flee and run out of the market and bleed money into it. So why don't we just step back and say that we don't know what's going to happen, but what if we just put a short sell order at that 134.5 level? What if we just admit that we really don't know, so why don't we put an order in at that 134.5 level, which will say to us that if the market moves to that level, we will enter in the short side, if there is enough supporting evidence. So that's exactly what we would look to do. Okay, that's exactly what we would look to do. Now I want you to have a look at that bottom right hand corner where I have circled. The date is the 10th of July 2014 because I want to draw your attention to this next slide where we see exactly what does happen when these floors give way. So that timeline that we are looking at is exactly where that circle is. And can we see what happens when that floor gives way? Can we all see the panic which existed in the market? Can we all see how far the market has pushed down? And can we all now understand how a breach of a floor, just like we saw in that Swiss National Bank example, when that floor gives way and when retail traders get it wrong, it gives us a potential opportunity to enter. So that's what we like. We like standing to one side. We like watching the retail traders as they go about their business, scalping a few pips or a few points here and there. We prefer to have the patience to stand back, to wait for a move to be generated, which will be worth our while to take advantage of. And even though this is coming up to the end of last year, we can see that up at this point we're still in that range, aren't we? We're still going up and down between that 103 to 110, back to 103, back to 110 level. Okay, so that's what we are looking at now. We're looking at almost the same type of opportunity, build and generate while all of the retail traders get sucked in to this sideways pattern, constantly losing money. We'll look at the same type of example on this oil chart. I was going to say gold. On this oil chart. And we can see again towards the middle part of last year, we can see that there was the same type of floor in the marketplace. We can see that time and time again, the market came down, bounced off that $57 area, went up, came back down, bounced off it, came down again, bounced off it time and time again. So let's see what happened. Again, we want to be mindful of the timeline that we are looking at. We're looking right through from the end of April until the end of June of last year. So let's have a look and see what happens. If the floor was maintained, the price would probably move away from it. But what happened was the floor was not maintained. We can see that exact same timeline and we can see what happens when that panic exists, when the retail traders get it wrong, when they are confident that when they are confident of their own action within the market, where their fourth or fifth or sixth trade is much bigger than the initial one, and that fourth or fifth or sixth trade subsequently does not work out in their favor. They panic, they run, they flee, and it allows us to take advantage of the subsequent action. We see this time and time again. We see a new floor appearing at this level of X. Can anybody give me an idea as to why, when the initial panic took place here, the market moved down and formed a new floor for a very short period of time at that level? What do you think was so attractive maybe about that level that would stop it from falling for even just a few days before it broke again? What do we think? Who's got it right? Who's first in? Bipin, I think you're first in with the right answer. Laura, you have it as well. Great stuff. If we look at the price level, If we look at the price level, you can see how emotional these markets are sometimes. We're slapped back on that $50 level, and people would have thought at that time, retail traders would have thought at that time, that okay, we're selling off from 58. I think by the time it goes down to 50, it's going to be cheap. I can't see it falling any further, so I'm going to put in a couple of buy orders at that level. So that's what happened. That's what stopped it falling initially. There were quite a few buy orders. So when the market moved down to $50, those buy orders were activated, which just caused a new and artificial floor to be generated. That floor remained in place for only a few days before once again it was breached. And when that was breached, there was quite a substantial sell-off right down to that $38 level. So we want to have a look at these floors, and we want to maybe understand them as far as perspective is concerned. So what I've done is I'm going to draw a little matchstick man here on the chart. And imagine this guy, he's living on the 5th floor of his apartment block, okay? And he's standing on his floor. When he's looking down, he can see a nice solid floor below him. However, below him on the 4th floor, we have his neighbor. Okay, so this guy, he is as happy as a clam living on the 4th floor of this apartment block. And when he looks up, what does he see? It might be an obvious question, but what does he see? Paul, you have it, absolutely. He sees a ceiling, doesn't he? So what can be a floor to one can be a ceiling to another. And that's exactly what we see looking at a chart like this. Can we all see that when there is a breach of the floor at that $50 level, the price continues all the way down to the $38-ish level, then it goes right back up, and what was support on the way down is now resistance on the way back up. Does that all make sense? It's all about perspective. It's all about what is happening in the market. It's all about the placement of orders. It's not about what you or I or we think. It's all about where people have placed their orders. And it is that order flow, that congregation of orders, which moves markets from one point to another. Okay? That's all that it's about. So this was one of the more recent charts of oil where again we see that sideways movement. Again we see that floor and ceiling take place. And what has happened since then, for anybody who's in any way familiar with the oil market, we know that it has fallen quite significantly even since this screen grab was taken. And it's now way down in the low $30 level. Way down. But what happens, what exaggerates the move, is that retail traders typically are more optimists than pessimists. They typically believe that markets will rise more than markets will fall. So when a floor is breached, the moves then tend to be exaggerated. We can see floor number 1 in that blue circle. It's breached. There's a sell-off. We can see floor number 2 in that second blue circle. It is breached. There is a sell-off. We can see floor number 3 in that blue circle, that third blue circle. That is breached. And again, there is a sell-off. Time after time after time again. It's as if they never ever learn their lesson. They're always too eager to enter without any real confirmation. It's more important to stand back, understand what is happening, not be afraid of the direction of the market and just taking advantage of it when it moves in a specific way as long as you have confirmation. So that's the supportive element. That's the floor of a market. Does everybody understand the concept behind it? Does everybody understand how a breach of an identified floor, when it does happen, it can create panic, it can create hysteria, which in turn provides us with opportunities? That's what we're looking at. That's all we are saying. A breach of a floor can provide us with an opportunity. Okay, so the reverse obviously applies in the exact same way. The absolute reverse applies. We have a floor and we have a ceiling. These areas are very, very useful. If the market hits off the top level, then we say it's called resistance. This could happen again for any reason whatsoever. What we want to focus upon is the stop losses of other participants in the market. We know what way they are operating because we are looking for our opponents. We're looking for these retail traders. A lot of people might be wondering, why do we do that? We do it in every commercial area which we are looking at. You're looking at what's being done before. You try to do it bigger, you try to do it better, you try to do it cheaper, you try to do it more efficiently. Whatever way you want to do it, you go out and you try to be better. If you are the market leader, if you're the first into a specific market, you might pave the way, but you always look behind you to see who's coming in your wake. When you're trading, you've got to look at who else is out there. You've got to ask yourself, who do I want to work like and who do I want to work against? And we want to work with the brokerage industry. Why? It's not because we like it. It's not because we're friends. It's only because it makes money. And it's just that simple. And then, shockingly enough, we know that individual traders, they have difficulty. And that's putting it very mildly. So we now know who we want to work like, and we now know who we want to work against. And this is a way of finding where those retail traders are losing, because that's where a market maker, where a broker will clear. That's the counter retail approach which we like. So if we look at the DAX, look at the German index, it's the exact same thing. You've got resistance to the top side. If the market was to breach above that, you will have people panicking and exiting. If the market goes to that level, you would look at longs. You would look to enter into the buying area, a long L for long. What you want to do is you would want to place an order so that if the market breaches that level, you would want a buy order placed to take advantage of the subsequent move which is bound to happen. Why? Because we know that retail traders are selling time and time and time again at that upper level. And again, the same question will apply in this instance. Why do you think people are selling? Why do you think people are selling at that specific level? Mark B, you have it absolutely right. Can we all see the level which is at? Sean, you're very good, and Oscar too, well done. Can we all see the level, the exact price level? It's 10,000 points. It's exactly 10,000 points, give or take. And that's a natural level for people to either want to enter or exit. On the way up, it's more natural that people will exit at that point because, Jeremiah, you have it. It's because the trader thinks that that is the highest point. They think it's a psychological level, Gavin. Absolutely, it's a psychological level which they believe the market will have difficulty in succeeding, in overcoming. But what happens when the market does indeed overcome it? We have every single person who sells at that 10,000 point level who flips and they go to the other side of the trade. So again, let's be mindful of the time frame. We can see that this is just over a year ago, coming into the end of 2014. So let's flick forward and see exactly what did happen. We can see this market all the way through that resistance zone at that 10,000 point level, all the way through to the end of 2014. We can then see a breach of that ceiling, a breach of that resistance point, and then a strong move above it. Can we all see that? And it's the same type of occurrence. It's the same type of occurrence because the same type of emotion exists. People panic, they flee, they take the opposite side of the trade. And again, we can see that that same emotional state of play is coming back into effect. And this obviously is only through to the end of March, early April of last year. But we can see that it went up to that 12,000 point area, and that 12,000 level became that new emotional resistance point. Okay, we can see the same type of action across any market. We've looked at the DAX, which is the German index. Now let's have a look at the Aussie dollar, US dollar. We can look at that left-hand side of the chart. We can see that there is a supportive zone and there is a resistance zone. We can see there was an upward breach where there was panic to the upside. We can see there was a lower breach where there was panic to the low side. Once that lower breach took effect in June of last year, we can see that a new floor and ceiling were formed. The market traded within that new floor and ceiling until again it was breached, again to the downside. Then we can see another floor and ceiling. This time the ceiling is still pretty much horizontal. The floor is somewhat diagonal, but it is the exact same type of effect. We have the exact same types of panic, the exact same types of traders making the exact same types of mistakes. And when we look at an area like this, right through from September, October, November of last year, let's zoom in and see exactly what is happening in this market now that we're into the start of the year. We can see the same type of approach. We have a channel. We have pretty much diagonal support and resistance. We have retail traders coming in and buying between both levels, selling between both levels, not really sure of what they are doing if there is a little breach above or below. Can anybody show me why I am able to say with confidence that a retail trader doesn't really know what to do when there is a little breach at X to the upside and when there is a little breach at Y to the downside? Why am I saying that they don't really know what to do? Why there is no real confidence in the market? Philip, you're first in with the right answer. Well done. Can we all see we have a long-legged doji where I'm placing that little dot to the upper end? How we have a very, very small doji right beside it. And can we all see down at the bottom end another dot? We have another long-legged doji. Then we have an inverted hammer. Can we all see that? It's hammering out the bottom. And it's only when we have an engulfing bearish candlestick back down that the market does indeed drop back into the room. That we're again bound by resistance, we're again bound by support. We have an inverted hammer, which is the most recent candlestick which we have. That inverted hammer, what does it normally tell us? Does it normally tell us that it can be seen to be hammering out the bottom? We couple that with the indecisive doji before it. These are the types of things that retail traders look for. And these are also the types of things which we can look for as counter retail traders because it tells us exactly what the retail trader is doing. Let's have a look at another current chart, a silver chart, and see exactly what was happening. We will draw our attention first off to last October into November. Can we all see the same type of pattern? We have a floor, we have a ceiling. We have the floor, which is the supportive line, the red line. We have a ceiling, which is a resistance point, which is the green line. Can we all see the panic which existed when that floor gave way? We had an elongated sell-off, a very, very steep sell-off for the first quarter, the first half of November. Ever since that point, what can we see? Can we see that there is a sideways pattern? Can we see that we have support to the lower end? Can we see that we have resistance to the upper side? Can we see that that supportive line, it's not a perfectly drawn straight line? Can we see that it is breached a little bit here and there when there is indecisiveness being exhibited in the marketplace? And can we also see that we have that slightly diagonal resistance line to the top end? So this is very, very important. This most recent chart of silver, we can see how it went right up and hit the ceiling and didn't go any further. Does that mean that there would be confidence to go long at that exact price of $14.12? Or would you be better off having a little bit of patience? Would you be better off perhaps placing an order so that if the market went up to, we'll say that level at L, that might be the best thing to do? To wait and see what happens. Adam, absolutely, I love it, to wait for confirmation. And can we also see that if the market moved down to the high 13s, to the 1370, 1380, maybe even 1390 level, would you have confidence in that situation to sell? Or would you be better off waiting it to drop well below a previous low point and then perhaps placing a short order? Would that be the better thing to do? To have that little bit of patience, to wait for this little battle between the bulls and the bears to play out, to wait for a victor to emerge and then place a trade. That's the type of thing which we prefer, and that's what we're going to be looking at as we progress through this foundation trading program. Let's have a look at it in another example. This is a historical coffee example. Okay? We'll zoom in on that bottom right hand side. We can see that it was within a support and resistance area. What we prefer to do in a market like this is we prefer to wait for that breach, to wait for the breach of the ceiling, and then we might place our stop loss back below the point where the market breached. Okay, so if the market went up and breached through it, we would have a protective exit point if it was a failed order. We would get out of the market, risk a lot less. Okay, the same would occur to the downside. We might say if the market goes below the floor, the same thing, we would short the market. Okay, we'd wait for confirmation. We would wait for a breach to occur. It might lead us to place an order to short the market. But if we were wrong, if the market turned around and went back up within that floor and ceiling, you would again place your stop loss at that point. So you're exiting the market at the earliest sign of a failure. Okay, this risk side of things, it's a massively important part of trading. I know I've mentioned it a few times already, but we are going to be dedicating a full class to it during lesson number 9. A massively important part of trading, and I would highly recommend that class, if no other one in the future. I would highly recommend that risk management class. Okay, so we like this type of approach. We say to ourselves that we never try to preempt a bounce. We say to ourselves that momentum, it's like a train. Okay? It's like a train on a set of tracks. And one would never step out onto a train track and say that I think that that train, which is traveling towards me at 80 miles per hour and carrying several megatons of material, you would never say that I'm going to stand here because I think that that train will stop and reverse before it hits me. Who would do that? Okay? Why would you do that? Would you not instead prefer to look at the train and say, you know what, that's pretty powerful, and it looks like it's going to keep going in its direction? Is that not a more logical argument? It's momentum. A body will stay in motion until something else impacts upon it. So that's the reason why we're going to be working with momentum, why we're going to be using pending orders, and why we're going to be waiting for confirmation. This idea of confirmation is crucially important because it is that which gives us the supporting evidence. When these areas break down, we get support, we get resistance lines. Okay, we get lines in the market. And that tennis ball breaching through that ceiling, it really is a sign of things to come. So we can measure this on the market making a new high. We can measure it on the market making a new low. Okay, we can measure it by breaches of a moving average. There are many different ways of looking at it, a lot of which we will be looking at over the coming classes. But let's say we're going to measure it on just new highs and new lows. We can look at a new high or a new low and we can ask ourselves the question, is it a false break or is it a genuine break? If it's a genuine break, it can typically continue much further. So what we're looking at is that the entry side of things, identifying a potential entry in any market, regardless of what it is, whether it's a forex market, whether it's the indices, whether it's a commodity market, any of the commodity markets, any of the individual stock markets, regardless of what it is, it's relatively easy to look at or to find or to spot a potential opportunity to enter. We've looked at the types of entries over the past few moments. When the market breaks through an area of interest, we say it's a breakout and we expect it to continue. As in these scenarios, when it breaks through specific lines, we say that it's very likely to continue. Let's have a look. We can see in this Dow Jones, the US 30, the top 30 companies in the US, when it breaks down through a trading range, through a floor and ceiling, we can see that panic exists. We can see how we can take advantage of a move like that. We can then see a new floor forming. Okay, we can then see a new ceiling forming, and then we can then see the activity of the retail traders at these levels of interest. And when we see something like that, we can see the potential for a breakdown. We can see the potential for an entry. We can see a movement of 1,000 pips between the down movement and the subsequent movement back up. These are the types of things which we like. These are the types of things which retail traders tend not to spot. How do we know that they don't spot them? We know because of the panic which exists in the market. Can everybody see the depth and the strength of those sell-off lines? And then can everybody see even the strength of the buying lines in the opposite direction? These were moves which caught the retail trader unawares. These were moves, where there was panic, where people exited and had to trade in the opposite direction. So these are the types of things that we like. And we can have a look at this market. Well, let's have a look at Apple. A lot of people have been asking us about charts, about companies like Apple, and to have a look at them and maybe try to explain them and talk about what's going on now, and is it expensive or is it cheap, or is now a good time to enter in the long side, or is now a good time to enter in the short side, or, you know, they might be reading some news about them, about concerns about the new release of a new phone. Is it supposed to be September, October of this year, where the iPhone 7 is supposed to be coming out? But there are concerns. Okay, there are questions which are being asked. So let's have a look at this historical chart. It's always good to start with the past. And when we look up at that top level, there was a clear ceiling in the market. So there's a question that I want to ask you. Is this price, is this stock at that level, is it deemed to be expensive or is it deemed to be inexpensive? If you think it's expensive, just type in EXP. If you think it's inexpensive, just type in INEXP. So, as is typically the case, a huge amount of people are typing in expensive. Very few, to be fair, there are one or two that are typing in inexpensive, but the vast majority, by a long way, are saying that it's expensive. Adam, you're saying it's relative. And absolutely, Adam, I like that. It's relative, it is indeed. Again, we want to draw your attention to the timeline. This is going back quite a few years now. We're looking at from 2011 into very early 2012. So let's have a look and see what happened after this supposedly expensive time. That same timeline is circled. We're looking from late 2011 into early 2012. This is where we had stopped on the previous chart. So can we all now see that, Adam, you're absolutely right. It's all relative, isn't it? It's all relative. What is expensive to somebody, there is a natural, almost human conclusion reached when somebody sees the price at the top right-hand side of a chart that they think it's expensive. That doesn't mean that it is that case. Okay, it doesn't mean that it is expensive. All it means is that it is trending strongly upwards. And if something is trending strongly upwards, you'd nearly have to ask the question, why wouldn't you want to be part of it to a degree? Again, as long as you have confirmation. But surely it would make more sense to jump aboard the train than to stand in front of the train thinking that it's going to stop and reverse. A more recent Apple chart, I think it's trading a little bit below these figures at the moment. This is one from just the end of last year. But we can see these same types of patterns occurring time and time again. We can see a resistance line and we can see a supportive line. We can see that the market goes down and bounces. There was some big news here around the end of August of last year. But the market recovered, moved back in, and we had this elongated trading range. There was a little bit of a pop above it. There was a lot of hesitancy when that pop took place. There was a gap in the market. and it went back down and settled back in its trading range. A lot of people asking about the gap. Okay, so can we see, let me just erase everything from the screen. You see a gap like this in the market. It typically occurs in stocks more often than anything else. Does anybody or does everybody understand? I can see already that a lot of people are asking, what does this gap mean? Okay, let's try to explain it. Okay, let's have a look. Okay, so gaps in markets, they're simply a consequence of supply and demand. Okay, that's all it is. It's a consequence of supply and demand. So let's relate it back to something that we might all be able to identify with. Let's have a look at a property market or at your own local housing market. Okay, and imagine a scenario. Imagine that. Let's have a think. Okay, so imagine that there's a number of houses for sale in your area. They're all for sale in and around the same price as they tend to be. They're all for sale, imagine between $350,000 and let's say $370,000. Okay, that's the price of housing in your area. $350,000, $370,000. So let's imagine that there's a lot of houses for sale. Friday evening comes, all of the realtors or all of the property estate agents, all of them in the area, they shut their doors on a Friday evening and they go off to enjoy their weekend. Over the course of the weekend, imagine that your local council came out and it said it was going to build a domestic waste incinerator in the backyard of your house. Okay, they were going to build a massive domestic waste incinerator in the back of your house. So when the market opened up, when those estate agents opened the door to their offices on Monday morning, what do you think will happen to the price of houses in those areas? Imagine they were selling for $350,000. So we're going to imagine they were selling for $350,000. After the news over the weekend of an incinerator being built in the neighborhood, do you think they'll drop to $349,999? Or do you think they will fly all the way down to maybe, we'll say $275,000? What do you think? They will dive, won't they? They will drop. There'll be a huge, significant drop in the market. Maybe 250, Kenneth. Absolutely, I won't disagree with you. We're in a fictional example. Why would I disagree? But that's exactly what happens in these markets. Okay, it's just supply and demand. It's not a case of just an incremental drop, one at a time and one at a time and one at a time. If bad enough news comes out, there will be a gap down. If good enough news comes out, there will be a gap up. Okay, so while the market is closed, news comes out, and you'll know that anybody who's anyway familiar with the stock market, with company news is always released outside of trading hours for that reason. Okay, they want the market to maybe adjust a little bit, to get familiar with the numbers, to understand what has been going on, so as not to create panic, not to create hysteria. Okay, Saul, you're asking if gaps only occur outside of trading hours. No, not only, Saul, but more often than not, yes. Not only, but more often than not, yes. That's one of the reasons why you rarely see gaps in foreign exchange markets, because foreign exchange markets are open pretty much 24 hours a day, 5 days a week. But again, if you have a foreign exchange market which does shut on Friday evening, if over the weekend you have the likes of Janet Yellen, or you have the likes of Mario Draghi, you have the likes of Mark Carney, if they are coming out and if they are saying something unusual that the market doesn't expect, perhaps there would be a gap in the forex market by the time the markets open again on Sunday evening or Monday morning. Okay, but that's all they are. Those gaps, they're just a consequence of supply and demand. Nothing more, nothing less. So we look at these types of breaks. We look then at exits. We look at reasons to actually get out of a trade. And that's probably the part that people tend to find most difficult. Okay, it's a very difficult thing to do because most people try to predict what is going to happen. Okay, what we need to understand is exits are massively important. Many people who have traded, they will know that entries, as I've said already, they are easy. You can go through an entry strategy in, maybe 2 hours or so. Okay, 2 hours during our most advanced offerings, we cover off entries without issue. Very, very easy. An entry is defined, or the success, the outcome is defined by its exit, not by its entry. What you do after the entry is what dictates whether or not you're going to make money. You could have the best entry system in the world. If your exits are terrible, the market will win. So when we talk about exits, people then ask, well, how many pips should our exit be? If there was one answer to that, if there was one simple answer, the world would be an easier place, but there isn't. You've got to basically measure the way that market is behaving as per your methodologies. What we look at are things like retracements, or things like returning into a range, about support and resistance reversing, all that sort of thing. It really can help. So if you're looking at an example just like this Apple chart, we have that same type of formation, okay? If you had gotten long above that breach, okay, could we all agree that when the market went down below that green line, when the market went down into the room, if you say, can we all agree that we would have gotten it wrong? So conceptually, a stop loss like that wouldn't be a bad idea. But we never ever use limit orders. We never ever use limit orders because we feel that limit orders, they limit our profits. So it's important, I guess, to make that distinction. We always use stop loss orders, but we never ever use limit orders. We always manage our risk. We never try to cut our losses early. And that's something that a lot of retail traders tend to do. Looking at it further, we look at profitable exits. Okay, profitable exits are massively important. We want to make money. You're not here just to listen to my Irish accent consistently. I'm sure you want to know how to profit instead. So what we like to do is we like to get out of the market when it clearly tells us to. If a market is rising in the most simplest of terms, when it stops rising, we look to get out. If a market is falling, the exact opposite applies. When it stops falling, we look to get out. We measure retracements. We'll have a better example of this in just a few moments. But if you're entering at a breach of either support and resistance, our initial stop loss would be back within the original range. It would be back within the original range. And then it's how the market performs thereafter, how it functions, how it interacts with what was support or resistance. Or it can give us clues based upon the type of candlesticks which are generated. That's the type of thing which we can look at in order to justify what might happen. Okay? These profitable exits, another scenario which we're going to be looking at in a lot more detail, in particular during lesson number 8, would be a moving average. We'll be looking at that in a lot more detail during lesson number 8. They can be a very, very useful way of trading. Retail traders are massive fans of using moving averages, simply because they give a very objective entry and they can give a very objective exit. If you were to enter at this top end, let's say you wanted to short the market, you might enter on a break of a moving average. Your exit point might then be when the price went back up and closed perhaps back above that moving average on the opposite side. So it does give that nice, that objective way of trading, which again is something we're going to be looking at quite a lot during lesson number 8. Trends and channels, they're very, very similar in most instances to these same types of floors, these same types of resistance. A trend is just a directional channel, if you like. It's either a channel which is trending upwards or it's trending downwards. We can see in this this US dollar Swiss franc example how we had that resistance point to the top end and we had that supportive diagonal line. We can say that it was trending upwards because every low that was hit at X, at Y and at Z was a higher low. So the market was gradually increasing. It was gradually rising in price, even though you could say it was still bound by a floor and was still bound by a ceiling. Because the directional force applied, the upside breakout was favored, which is exactly what happened. And then we had a strongly trending move to the upside. You might then ask, well, how would you get out of a trade like that? We can all identify this channel to the upside where we have our diagonal resistance, where we have our diagonal support. The market was moving strongly. Okay, moving strongly in that direction. You might have been in that trade since you had your initial breakout at X. So you are now looking to identify a way out. Let's have a look at one of the most recent charts and see if anybody can tell us where an exit might have been identified. Can anybody give me, whether it's a date or an approximate price or whatever the case may be, as to what might have been an exit for you? What do we think? Can we see that? Absolutely, we have a couple of dojis at the top. I don't think this doji in particular at X would have been a reason enough to get out. We have another red candle beside it. That's okay. But can we all see that we had once more a clear breach of what was support? It was diagonal support, but it was support nonetheless. So that could have been a second signal to exit. You had confirmation number one with a doji, another doji perhaps beside it, but you had further confirmation with a breach of support, and then obviously we have a massive movement to the downside. So that would have been ample signals to exit. The most recent chart, it's showing the exact same type of pattern once more, isn't it? The exact same type of pattern. We look at the Aussie dollar, US dollar. A lot of people asking about this chart. We can see again the same type of thing appearing. We have resistance, we have support. Okay, we have retail traders always trading within these levels. What we try to do is we try to identify whether or not a break will exist. If a break exists, we take advantage of it and the subsequent move which will occur. If a break doesn't exist, we have enough patience to stand back to realize that that is the case, to bide our time and to then trade accordingly. What we tend to look for as well is we tend to create a micro area for counter retail trading opportunities. Okay, and when you see a massive breakout like we did at the start of this year, we know the retail trader is losing, we know that we are winning. When we're trying to find our way in, what we have on the screen now is one of our own proprietary methods on the screen, where we jump in where the candlestick hits that blue line. It tells us to enter and we capture nice opportunities. That's the type of thing that we like to do. We like to combine everything together to find real opportunities. So we're going to have another poll this evening. We're going to look at another chart. We've gone through quite a lot as far as technical analysis is concerned. Let's see if it has allowed you to make any particular decisions as to what could be happening in a current chart. We're going to look at silver. Okay, we looked at this quite briefly already. I gave you a couple of clues. This tonight might be a bit of a test to see who was listening and who wasn't listening. So at this point in time, with silver trading around about that $14.13 area, what would you do? Would you go long or would you go short? Or would you do something else? What do you think? Would you go long? Would you go short? Or would you do something else? And I'm absolutely delighted to see a huge amount of people typing in the type of answer that we are looking for. The one indeed which we have already talked about, spoken about, gone through this evening. We have a floor. We have a diagonal ceiling. So the best thing to do, this is the first chart where I'm going to tell you what we would do, is absolutely what most of you are typing in. We would wait for confirmation. Okay, we would wait for confirmation. And this confirmation is what we're going to be looking at through the second half of this foundation trading program. So this evening, we've covered support and resistance, we've covered breakouts, trends, channels, all part of the one family. You now know what normal retail traders do. You now know what they tend to look for. It's important for you to know this because we want you to become a counter retail trader. Massively important to realize that. We don't want you to become a retail trader, we want you to become a counter retail trader. The next steps, as always, to attend the classes live. The next session will be further technical analysis. We're going to be starting to build your trading toolbox, which is absolutely imperative in order to look for opportunities. Of course, the recording will be available within the next, we'll say 24 hours, but should be up by about 14-15 hours, there or thereabouts. Absolutely for revision purposes, to go through anything which we've covered to date, go into academyft.com, go to top right hand corner, and click sign in. A quick word on Show Academy, a quick word on what we're about. We are, as a company, absolutely fully focused upon the educational event. Something which we've launched at the very earlier part of this year is throughout 2016, throughout this year, we're actually going to be giving away $30 million worth of education to the most deserving of causes. We believe that education is absolutely paramount, not only obviously in trading, but in the massively wide range of other subjects which we offer out into the marketplace, whether it's nutrition, whether it's photography, whether it's marketing, whether it's social media. There are a huge range of subjects which we are focusing upon and expanding on throughout this year. We're dealing with governments at this stage, thankfully. We've got personnel in place who are adept, who are fully focused on making sure that our services are as accessible as possible to as many people as possible. And this is one of the reasons why we like to ask you for reviews, okay? What we are absolutely appreciative of are the reviews which you have left us already. I know that I asked you to do it during the last class to go onto Show Academy, go onto facebook.com/Show Academy and to leave an honest review. And I want to thank every single one of you who has done so. I also want to thank those of you who have brought to our attention maybe one supposed review in particular. I guess at this stage, because you would have left a review yourself, you know what a good review is. And by good, I mean honest. I'm not talking about a flattering review. I'm just talking about an honest review where you're able to talk about the quality of the education, where you're able to talk maybe even about the accent that I have, whether it's good or bad. Is my speaking voice clear enough? Is it obvious that I know something, or is it obvious that I don't know something? Is it obvious that we're trying to teach in the correct manner, or is it obvious that we're trying to bluff people? And I think we can all appreciate what an honest review is. This other particular, we'll call it an article more than a review, I guess. It was put in place by an individual who is simply looking to tarnish us, because he's trying to extort money from us. Unfortunately, in the online game, in the online world, in the online space, that is what, basically we'll call him a criminal. He is a criminal. That is what they are looking to do. They look to try to extort money from companies by posting an article which is not a review in any way, shape or form. An article gives pros and cons, gives pluses and minuses, gives a good opinion as to what is important, what is not important, what is good, what is bad about a particular subject matter. When something is, if you like, very one-sided, everybody can identify it for what it is. And we're appreciative that you have spoken about it to us, and we absolutely appreciate the good reviews which have come in besides that, okay? We are absolutely always looking to improve, and we need you to tell us exactly what we need to do in order to make these improvements. Larta, I'll absolutely take that on board. I do appreciate that I do speak quite quickly sometimes, so I'll endeavour to slow it down a little bit in future. A little bit less coffee maybe throughout the day for the next class. But many, many thanks. Massively appreciate it. Okay, so what we'll do now, guys, we're a little bit over time, unfortunately, this evening. I hope you don't mind, but we will have our Q&A as normal. I'll take give me about 30 seconds or so, there or thereabouts. I'll give the throat a bit of a rest, but I'll be back as quick as I can to go through anything that is outstanding. So please type in any questions. Marie, absolutely. Type in any question that you have, and I'll do my best to answer it very, very quickly. Many thanks. Okay, let's have a quick look. What have we got? What have we got? What have we got? Marion, you're asking if we're going to be talking about trading robots. I will indeed, no problem whatsoever. We'll probably cover it maybe during lesson number 9. What else have we got? Gosh. Okay, let me see what I can do. And Japanese candlestick, Natasha is asking, are we trying to find if the market has risen or fallen? Are we trying to, or apart from identifying the movements? Well, we would know, Natasha, by, I suppose, the very nature of the candlestick itself, as to whether or not the market has risen or fallen. We're more interested in using the information which the candlestick gives us as a way of identifying what the retail trader is doing, so that we can then trade opposite them. We can then counter retail trade. But obviously this is something which we're going to be looking at in a huge amount more detail as we progress. David, you're asking, should floors and ceilings be determined on a continuing basis or periodically? Honestly, David, that's a tough one to answer, simply because they're going to be dictated by the market. They tend, I suppose, even by the examples which I've shown you this evening, they tend to be built or to appear on a continual basis by their very nature until they're broken. And once they're broken, the market might float around a bit before a new floor or ceiling is found. But if you go back even and review the recording of today's class, you'll be able to see that for yourself. You'll be able to see in the examples which I showed you that every time that there was a breach, that there was, if you like, a number of days of panic or a number of weeks of panic before a new base was formed, or before a new resistance point, a new ceiling was formed, and the market then reacted accordingly with that. Let me have a look. Brandon, you're asking, is a trend worth making a decision on if it's less than a specific amount of time, like on a 1 year chart? Trends less than 2 months are not a sufficient enough trend. I wouldn't say that at all, Brandon. I wouldn't. I don't take time into the equation at all, really, when I'm trading. It does take a little bit of practice. I do get that. I do understand that, and I am very sympathetic, if you like, or mindful of that. That is not a case where we would expect anybody here to go out and to be able to identify a floor if I was to show you a chart right now. But it does become a little easier with time, okay? Now, like all things in life, you're never going to be fantastic at it first time out. But let's say even by the time we get to next week, by the time we get to lesson number 7 next week, by the time we actually access a trading platform, by the time you are able to generate your own charts, if you like, or look at your own charts in your own time, this will become a lot easier. And it'll become a lot easier, I guess, because you'll be able to use the tools associated with the platform as well. And you'll be able to just draw these lines, even if it's in a haphazard, random nature. You'll be able to draw it, see if it works out, delete it if it doesn't, draw another one. Maybe that one will work out. If it doesn't, draw another one. So it's about a little bit of practice. It's about, I guess, having the confidence just to try it out in a safe environment and then see how it works for you. What else have we got? Wally, you're saying the process seems easy when looking back historically. Is it this easy when trading live? It's never going to be as easy, Wally, when trading live. It's easy to talk with confidence when you know what happened, isn't it? Like everything in life. But it is about having that same kind of confidence when you are trading live, about having a trading strategy which works, about applying that trading strategy, without question, and then just having full faith in your risk management side of things, which again, as I've said already, is massively important. It's more about the risk side of things than anything else, in my opinion. What else have we got? Would I consider the various chart time frames when looking for support and resistance, Vidar? I would always default to a 1 day chart where each candlestick is worth 1 day. But yeah, I'd flick through the different times, the time frames when necessary, whether it's just out of interest or maybe just to confirm my own decision or whatever the case may be. Yeah, I don't mind doing it at all. And again, we'll be taking you through it as we progress a little further. Dave M will be helping you with charts obviously next week, no problem whatsoever. Paul, you're saying if I have placed a stop loss, but when the markets are closed, the next opening price is below it, is your stop loss price still realized? The short answer, Paul, is no. If there is a gap in the market, no price existed within that gap which would get you back out. So your exit, your stop loss would be at the next available price, the next nearest available price, which is most likely the opening price, which would mean that you would, in that situation, probably lose a little bit more than what you would have thought. Okay, but again, by having that correct risk management process in place, it would mean that it should still be absolutely of very little consequence to you. What else have we got? Ramesh, you're asking, is this program focused from the point of a trader or from the point of an investor? I would typically say it's more focused on the point of a trader, Ramesh, to be honest with you. An investor would be somebody who typically buys and holds for quite an extended period of time. Whereas a trader would be somebody who both buys and sells in the reasonably short period of time, whether it's a number of days or a number of weeks or even a number of months if the market is moving in your favor. What else have we got? Larry, you're asking, is technical analysis viewed as beginner stock trader method? I don't believe so, Larry. I don't believe so whatsoever. Technical analysis is a valid way to analyze a market for a lifetime, basically, on an ongoing basis. No problem whatsoever. What else have we got? Deborah, absolutely. I did say I was going to have another option for PowerPoints. Forgive me. I promise you I will for the next class. I promise you I will for lesson number 6. For anybody who is not on Facebook, I will have another solution for you. And Natalia, that might answer you as well, if that's okay. What else have we got? Andy, you're asking if we can have a chat about a bearish trade. The question specifically is, if you have not bought, how can you sell to benefit from the price drop? Yeah, it's fun. Maybe probably the most difficult thing for people to get their heads around, Andy, if I'm being completely honest with you. Everybody's familiar that you buy low and sell high. Everybody's familiar that you can only sell something if you have it to begin with. Trading isn't like that, and that might be a very flippant way of just saying it. But in trading, we're not looking at a physical asset, okay? If you buy oil, when you're trading, you're buying it because you're speculating that the price is going to increase, okay? That you're going to be able to sell it in a few hours or a few days or a few weeks, and you're going to be able to get more for it. But after you buy it, you don't get a knock on your door at 2 or 3 or 4 days later and your postman is there with a barrel of oil, do you? You're not buying the physical asset. What you're doing is you're speculating that the price will increase. And if and when it does increase, you're going to sell it and you're going to realize the difference between both. Okay? If you bought it and if the price dropped, when you sold it, you would then realize the difference and you would make a loss. Okay? Now, shorting the market or selling the market is literally that flipped on its head. Okay, you can sell oil without having bought it. You can sell oil because you think that it's going to fall in value. Okay, so you can sell it because you're speculating on the price going down. And if and when the price then goes down, you close the trade, you buy it back. And if it has gone in your favor, if the price has dropped, you realize the profit from that price drop. Maybe a useful analogy, even though, again, for some people, I'm running the risk of confusing people even more, but maybe it's a risk that I have to run. Imagine that you were interested in cars. I don't know whether or not you are, Andy, but imagine that you were. And imagine that one of your friends who had no interest in cars came to you to say that they were looking in the market, they wanted to buy a car, they weren't sure what to get, but they liked the look of a BMW, they liked the look of a 3 Series, and they had, let's say, $10,000 to spend. So imagine that was the case. You know a bit about cars. You're not a car dealer, but you know a bit about cars. So you said, you know what, I'll tell you what. I'll make a bit of money in this, so why don't I go out, I'll make sure that we have a car for 10 grand, I'll get you the exact one that you want, no problem. So what you've done in essence is you've just sold the market. You've just sold a car to your friend for 10,000. So how would you profit? Ask yourself the question, how would you profit in that scenario? If you'd sold the car to your friend for 10,000, how would you profit? You would profit by being able to go out and buy one for 9,000. So you buy one from another guy for 9,000, you sell one to your friend for 10,000, you've made $1,000. Okay, so it's that type of idea. You're speculating that you're going to be able to buy it back at a future price and time for less than what you sold it for. Okay, that's what it is. All right, that's all it is. It is difficult. I'm very again, it's something I am mindful of. I think even when I was going through lesson number 2 and I spoke about this short selling aspect, I said that it is, without doubt, in my opinion, the most confusing part of trading. But by the time you get to the end of this course, you will get your head around it. You're just speculating on the price difference, nothing more, nothing else. You're speculating on price movement. George, you're saying you're some friend. I like that, George. I like that. But look, it's business, isn't it? It's business. Okay, what else have we got? Which have we got? I think that might be about it, guys. Maybe I went on for a bit too long talking about prices and cars. Okay, Philip, good question. You're asking if there's a time limit on the short sell. There's no time limit either way, Philip. There's no time limit on the buy side or the sell side. None whatsoever. Shri, no problem at all. Many thanks, Shri. I hope I answered any questions that you might have. What else have we got? Omoro, you're asking which company pays the price difference. Which company pays the price difference? The market pays the price difference, Omoro. The market pays the price difference. Mark, you're asking, you charged for each day there is an order in place. You said short sell. Mark, it's fine. I've shortened your question a little bit because you are charged every single day that your order is open. I don't mind that though, because the only way I would have a market open is if it's working in my favor. If I have to pay for that to happen, I'm happy with it. You do have to pay. It's an unavoidable charge of trading. It's called an overnight swap rate. Do we cover it a bit more? Probably we do. I'm fairly sure we cover it a bit more. But there is an overnight charge. It is something that is unavoidable, but it's not a problem. It should never impact your trading. Liarta, you're asking about Shake Shack. If I can have a look at that chart. I'll do my best. Liarta, I will do my best. No problem at all. Chris, you're asking if there's going to be mock trading for us to test our knowledge. There is indeed, Chris. From next, when is it? Lesson 7 next week. We have 3 classes next week. 3 on the trot, one after the other. So lesson 7 next week. You'll be on a practice trading platform. You'll be able to do some mock trading with no risk, obviously, to yourself. A free practice trading platform. What else have we got? It's online, Amir. It's online. Vincent, yeah, we'll be taking you through all of that next week. Let me have a look. Jeremiah, you're saying that you were told in a trading seminar that you should never short sell due to the risk of unlimited losses, and that if we short trade, it should be through an options contract. Does that sound accurate? Yeah, absolutely, Jeremiah. Absolutely. I would never short sell the physical asset, if you like. But if I was to short sell, it would be through something like an option, which is what we do. It's something like an option. It's not exactly an options contract, but it's something very similar to it, insofar as you do have a get out, because your get out is your stop loss, where you are limiting your losses, which again we'll cover next week we'll cover that the week after next during lesson number 9. Amora, as I've said already, we're going to be using a trading platform next week. We're going to be looking at a trading platform and going through it in a lot of detail in a simulated trading environment with no risk to your funds. I think that's about it, guys. I think that's about it. Frank, I like your idea to a degree, but you're talking about cyclical movements. I much prefer, Frank, to look at the momentum of a chart rather than we'll call it a cyclical movement. The momentum, which exists when there is a breach of a resistance point or a supportive point, and other areas, obviously, which we're going to be looking at next week as well. A lot to cover yet. We're only halfway through the course, and look at the the progress, I guess, which you've made from lesson 1 to date. We're hopefully going to make the same, if not more progress, between lesson number 6 next week and lesson number 10 the week after. So quite a bit of way to go yet. I think that's about it, guys. Sujit, you're asking what is a professional trader. I consider a professional to be anybody who's hoping to make some money from their activity, regardless of whether or not it's trading. Okay, I think that's about it, guys. What I will do is, I promise by the end of lesson number 6 next week, I'll have something else in place for those who don't have Facebook accounts, for you to be able to do something in order to achieve those PowerPoints up to the end of lesson number 6. For anything that's outstanding, I'm sure that our team has been in touch with most, if not all of you at this stage, whether it's by email or on the phone. Obviously looking for feedback, looking for some constructive criticism, if you like, of what you liked, of what you didn't like. More importantly, they're making sure that you are getting from this foundation trading program exactly what you had set out to achieve, to make sure that we are answering your questions throughout. So make sure that you stay in touch with us, make sure that you stay in communication with us in order to ensure that you get exactly what you want from it. Okay, so until next week, gosh, we're going to be going into the 3rd week in January next week. Until next week, I hope that you have an enjoyable weekend, even though it's very early or a little early in the week to be saying it. And I look forward to speaking to you all the early part of next week once more. All the best, guys. Take care for now. Bye-bye.
Now, I'm not saying I don't like kids. I like kids. I have fun hanging out with my friends' kids and joking around with them, whatever. They're great. But I do feel like when I talk to my friends that recently had kids, it does seem like they had to give up everything for the kid. And that's very scary. If you want to have a depressing conversation, talk to a couple that just had a kid. Ask them about the last night they went out for themselves. They will describe the most boring, typical, mundane evening out.